Okay, so let us start because we have quite a bit of content to cover today and we have 1 hour. So as today's topic will be about intercompany loans in Singapore, but obviously Singapore cannot be looked at on isolated basis. It's also about, that's anything in TP is about managing loans in the region. So let me just start by introducing, and I guess the relevance of this topic has always been critical for anyone in the Asia Pacific region, particularly because it's one of the most common transactions within multinational companies. That's point number one. Point number two, there is inconsistency of views in the region as well. And point number three is there has been some changes in, in Singapore under Singapore transfer pricing guidelines that are also worth looking into. So for those who are new, just a brief introduction about our firm. We are Transfer Pricing Solutions, a company that specializes in providing practical, proactive, and cost-effective advice to multinational companies in the region. We have several accolades and have been nominated Tier 2 firm in the region for transfer pricing services as well. We also do now some aspects of international tax advisory and the fairly new and complex global minimum tax. So for those of you who don't know me, my name is Adriana Calderon. I'm the lead partner for our firm in the Asia region, co-founder of Transfer Pricing Solutions Asia and Malaysia with extensive experience in international tax, domestic tax, before in the Big Four, mid-tier firms, advising multinational companies in the areas of I always share that I started my career the traditional way, first domestic tax, then international tax. Back then, TP was part of international tax. And now, over the past 16 years in transfer pricing alone, even though it seems like my heart somehow always come back to tax, hence going back to global minimum tax. I have with me today one of our managers, Bingjin Yam, who has been with us for about 2 years plus. He started his career in transfer pricing in 2010 in Big Four in Malaysia. He assisted two of the first three unilateral advanced pricing arrangements signed with the Inland Revenue Board of Malaysia, as well as the subsequent annual compliance report for APA signed. He managed a portfolio of clients comprising companies with a broad range of industries such as automotive, pharmaceutical, electrical and electronics, FMCG, construction and property development, semiconductor services providers, oil and gas, as well as Chinese investors for transfer pricing compliance, audits, and planning. So he has been also doing a lot of training with us in different organizations. So you might have seen us before as a duo doing several webinars with ACCA, with SITP, with ISCA, and so on. So let us start with what we are going to cover today. We will talk about the regulatory landscape of intercompany loans, loans and TP and how one can approach it. And then we will discuss some of the changes in Singapore and what you should practically be looking for. So, Bingjin, why don't you just start giving us a little bit of an overview? Maybe today we will talk a lot about what's common in the Asia Pacific regions, and then we will also explain some of the aspects that are not so, there is not so much consistency, and therefore one has to look at it case by case. So why don't you start with giving us a little bit of a overview, Bingjin, please?
Sure. Thanks, Adriana, for the introductions. So I guess nowadays intra-group loans are very common compared to 20 years ago, where a lot of times that companies still 20 years ago prefer to use inject as a capital rather than loan, and nowadays due to some tax planning, seems like loans are more preferred. Okay, so why are those intra-group loans are so common nowadays compared to back then? So multinational groups often need to move capital efficiently cross-border, rather than each of the subsidiary that who requires funding or for short-term or long-term purposes going to external banks individually, the parent or the treasury center of the group of companies can provide loans to them by extracting excess fund from each of the individuals' respective companies and provide to those companies that requires cash. The loans may fund working capital, expansion projects, acquisition, or even cash flow support during difficult times. On the surface, this arrangement looks simple, but from a transfer pricing perspective, loans raise unique challenges. Are the terms truly arm's length? Is the interest deduction allowable? And does the loan itself even qualify as a genuine debt? That's why tax authorities across Asia, including Singapore, Malaysia, and Australia, pay very, very close attention to them. So so these are the reason being why nowadays loans are so much being the focus area of the tax authorities in different regions. When we talk about intra-group financial transactions, the starting point is always the arm's length principle. So the OECD has made it very clear that related party transactions must be priced as if they were between independent parties. So for loans, we need to ask, would an independent lender with no group relationship agree to these terms? And would an independent borrower accept them? If not, adjustment may be made. This could mean disallowing excessive interest, recharacterizing debt as equity, or even disregarding the transaction altogether. So perhaps our audience today, you could relook into the intra-group loans that you've entered into. So in the event of you were to lend it to a third party, are you going to agree with the same terms? Or if you were to borrow it from a third party, are you going to agree with the same terms? So this is a very rule of thumbs, the fundamental of arm's length principle that OECD or even all the tax authorities are looking at. So the principle is captured in Article 9 of the OECD Model Tax Conventions. It says that, if conditions between associated enterprise differ from those that independent enterprise would have agreed to, then the profits that should have accrued may be reallocated for tax purposes. In other words, if a subsidiary pays too much interest to its parent, the tax authority can deny that the deduction and the tax the subsidiary as if it had only paid at a market rate. So this underpins that all transfer price adjustment involving intra-group loans. Next one, please. While there are, in terms of transfer pricing analysis, there are 4 steps that we are looking at when we are looking at intra-group loans intra-group financing. First one, step 1 will be the business and functional analysis. So we are looking at the functions of those borrower and lender, whether it's a pure lender and borrower relationships. Second thing is industrial analysis, looking at debt market conditions for that particular industry. Is it making sense to have loan to be lent? Because in some industry, no loan would be granted by an independent financial institutions due to the volatility of that industry during that particular year. Third step is that what method to be selected, which transfer pricing method to be selected to determine what is the arm's length interest rate for the intra-group loan that has been entered into. Last but not least is the market benchmarking. So depending on which method has been selected, of course, we have to do a benchmarking to determine what is the arm's length interest rate that is appropriate for that intra-group loan. Okay, now let's take a step back and let's see what do we mean by a loan in transfer pricing. So as we all know, that loan is literally a monetary agreement between a lender and borrower. So the borrower promises to repay the principal plus the interest, usually under specified terms over a period of time. loans are the senior in the capital structure, meaning they get priority in terms of when it comes to bankruptcy. Loans can be secured or unsecured loan. From a transfer pricing perspective, the critical point is that whether the instrument has the characteristic of debt, which means is there any repayment obligation, interest, enforceability, or whether it looks like more like equity in discuss. So this is what we have to determine whether the loan is a loan or more to equity in nature. Well, there are different types of loans, which I think most of our audience are well aware of, which is revolving loans are flexible and may be drawn, repaid, and redrawn. Then it's often for working capital purposes. While terms loans are disbursed upfront and repaid over time. Typically, there's a fixed schedule of repayment. Some are delayed draw loans, while where disbursement happen in tranches. The loan structures affect risk and therefore affects what's an arm's length interest rate should be. Well, when it comes to how do we approach loans? So first thing, we have to analyze the contract. So we have to analyze the intra-group financing contract to see that whether those terms that have been agreed are consistent with a genuine loan. Do the clauses reflect what independents would agree to, or was there any excessive or unusual terms and conditions that has been agreed in the intra-group loans contract? Step 2 is to benchmark the interest rate. This could involve concessions, whether it's at internal caps, or is there a requirement to do a full comparability analysis? So we'll go through one by one in the following slides. Next one, please, Adriana. Okay, the loan contract is the foundation of an analysis. So the first thing, of course, whether it should, a loan contract should specify obligations clearly. What is the repayment schedule? What is the interest payments? Whether the lender has the rights to enforce or any covenants that for that loan. Without this, the tax authority may argue the transaction is not really a loan. We can also check that whether borrower could have obtained funds externally. If not, the arrangement may be riskier than it appears. So the first thing is that whether to assess whether the borrower the capability to pay by looking at the cash flow statements of the borrower as well as a profit and loss statements to look at what is their cash flow positions in order to assess is it something that borrower could have obtained the funds externally. If yes, then is the loans that extended from the borrower to the extended from the lender to the borrower is still a loan or is not? If it's not, so yep, this is something that the step one that we always do. So please ensure that your company has an intra-group loans agreement readily available when you are extending a loan, including your advances or payment on behalf. Next one, please. So for this example, you could see that company A is a leading manufacturing of in the group. They channel funds via equity and debt into the financing entity within your group in a low tax jurisdiction. So financing entity then extend the loan to company B at USD 100 million at the interest rate of 8%. But bear in mind that now with this one, the terms of the loan is 10 for 100 years. There's no repayment clauses for the principal, and company B is only required to pay only when the company making a profit. So if we look at this kind of terms and conditions, if you were to obtain such a same loan with a third-party bank in the market, is this something that the bank would have agreed to the same term? So clearly, there's no independent bank would agree with the terms that, the loan of the tenure for the loan is 100 years and only be repaid when the company is making profit, the borrower is making profit. Hence, in such cases, tax authorities may reclassify the instrument and disallow any deductions for it.
Yeah, so I think this is an interesting case because I think it shows the difference on how the regulations are before and how they are now. So in the past, depending of the local regulations, and particularly Singapore coming to not being too strict when it comes of leverage ratios and debt to equity ratios in a company, then there was a general understanding that as long as I call my loan agreement a loan, that is enough to give the loan the characteristics of a loan. Even if I didn't have repayment clauses, even if I didn't have clarity on the condition of having to pay. So before, in the old way of doing TP, the focus was mainly on the interest rate. Is the interest rate at arm's length, yes or no? And if my domestic legislation had some limitation of level of debt or some limitation of or definitions of what is loan for tax purposes, then that will also come into play to be able to determine whether a loan is a loan in substance. But as the regulation is today, at least for Singapore, yes, we don't have debt to equity limitations because a company in Singapore can be highly leveraged, and that's okay. Meaning to say we don't have a limitation or regulation, but TP rules will come to play because our TP rules in Singapore are very much based on substance. So if my contract says that is a loan, but it doesn't have the clauses of a loan, the view in Singapore will be very similar to in other countries where the instrument can be recharacterized. And I think that's the key here in step number 1, right? That you have already elaborated, like the necessity to have a contract that first have a contract, because there is a lot of companies who actually don't even have a contract to formalize the loans in Singapore. They just advance and they just let it become a non-trade payable, but then there is no clarity of when it was entered, whether there is a repayment clause, and so on. And second, making sure that the contract actually has the clauses that are of features of a loan, because in Singapore, now we have very clear substance over form rule, and that applies equally to loans. And in the recent 2 TP guidelines update, it has become even more clear that IRA's view is that we will establish a loan being a loan based on the clauses of the contract and what in substance it obligates the borrower. So once we have established the whether a loan is a loan from a contractual basis point of view, then the question is, okay, how can I go about setting up the interest rate? And in Singapore, what we have basically is 3 possible avenues. The first one being our indicative margin rates or concession for loans. Second is the possibility for looking at internal comparable uncontrolled price, which will explain under which circumstances we have internal comparable uncontrolled price available and what data can be used for that. And if I don't have any of these options, then I will have to go down the path of transfer pricing analysis. Now, we have one peculiarity in Singapore, which is that now from 1st of January 2025, these rules kind of apply equally for domestic loans and cross-border loans. Because in the past, when it was a domestic loan and there were certain conditions being met, it was understood that the domestic rule on a restriction of interest will come to play. But that rule has been overriding, and we will summarize it towards the end of this webinar, has been removed from for loans entered from 1st of Jan 2025. And now what one has to look is equally to agree on some interest rates as if the loan was cross-border. So in other words, the difference on treatment on domestic versus cross-border has changed, and now it has become more equal. And IRS has been quite clear in the expectation that if a loan is in substance a loan, then interest rate should apply. Now, what is the concession that we have in Singapore? What you have in Singapore is the indicative margin rates that can be applied. So before 1st of Jan 2025, this indicative margin rate applied in the same way for cross-border loans and for domestic loans. From 1st of Jan 2025, the rule has changed a little bit because there are certain conditions that apply for cross-border loans only. These conditions actually don't apply for domestic. So the condition for cross-border is that the related party loan should not exceed 15 million for the value committed and not utilized. If that's the case, one can use the indicative margin that is published by IRS at the beginning of every year in their website. For this year, we have that is base rate plus 1.7%. So 1.7% is what IRS understands as a rule of thumb of being the market interest rate. If you are doing a fixed rate, then the way in which you set up the interest rate is very similar. It's just base rate plus 1.7%. It's just that you fix that base rate and you agree on a total interest rate for the term of the contract. This indicative interest rate in the context of cross-border loans domestic loans can be used regardless of the value of the loan. That's the difference. So in other words, what IRS is saying, because we want domestic loans to have an interest rate, we are going to make it easy for you, and we are going to accept that you use the indicative interest rate for all domestic loans, as long as you are not in the business of borrowing and lending, and regardless of the value, which is a huge concession. But I guess the concession comes from the point of view of making sure that all domestic loans also have interest rate. And so there is no need to go overboard on the analysis. Then for domestic, you can apply the 1.7 plus base rate. But if it's cross-border, then there is a limitation on the value. So if the value is above 15 million, then you have to consider either the internal cap or the external benchmarking. So let's see the following example. Can a company apply the IRS indicative rate? So we have company A is a distributor of electronics that provide a loan of 13 million to company B located in Malaysia. So can I use my indicative interest rate? In this scenario, because it's a cross-border loan and it's 13 million, I should be able to use the indicative interest rate. But if we move the example above, and company A and company B are both in Singapore, and let's say that our loan goes up to being 20 million, I can still use the indicative interest rate, mainly because in domestic loans, there is no limitation on the value of the loan, whereas in cross-border loans, there is a limitation, which is 15 million. Now, one question that we get asked a lot, and I know Benjin has resolved quite a few of these questions. Is it acceptable to use a deposit rate as an interest market rate? What do you think? And the possibilities are yes or no?
Well, the answer is clearly no, right? Because I think a lot of our clients argue that, well, if the lender is not going to lend that money to the borrower, they will have just placed their excess of funds in the financial institutions, and they will just add on a fixed interest for it. So to them is an opportunity cost per se that you know, since I'm going to earn the same amount of interest from them, then I will just use the same kind of interest deposit rates to charge my loans to my borrowers. So unfortunately, the answer is no.
Yeah. So I think you have mentioned it correctly. Some people tend to say like, oh, I use deposit because maybe I just use the opportunity cost angle, and that's the methodology that I can use. And what Iris has said very clearly, not only Iris, like this is consistent across the region, that the methodology of the opportunity cost is actually not a reliable way of pricing a loan, because deposit rates is a risk-free rate. And in theory, when I lend to my related party, I need to consider the likelihood of default of the borrower as if it was independent. So because of that, the deposit rate is actually doesn't cover the risk for me giving up my money to the related party and the likelihood of default. Hence, the expectation is that I use, yes, base rate, which is a risk-free rate, plus a margin, not a risk-free rate alone. And it is important to clarify this because we get asked a lot this question. So keep in mind the differentiation between the possibility of using indicative margin for domestic loans versus cross-border loans, in the sense that for domestic loans, the rules are quite more beneficial because you can use it for any type of loan as long as you're not in the business of borrowing and lending, whereas in domestic, you have the value limitation. And if it is available, then it's something that is worth using. Having said that, limitation on this, that is only acceptable in Singapore, is not enforceable in other tax authorities. So that's something that one needs to also take into consideration. So then the question is, okay, what are the options for internal CUP and what is the internal CUP? And then the possibility of internal CUPs is basically what we also call as using internal cost of borrowing as well, to some extent. So if we see in this example, I can have a lender, related party X, that lends to related party Y, borrower. So under the possibility of having a cost of borrowing, I can take a look at three different possibilities. Possibility number one is looking at loan A, which is, okay, if the lender provides or offers loans to third parties. Now, this example is a bit unrealistic because the reality of it is like there is, unless I'm in the business of borrowing and lending, there is a very high chance that I don't have loans that I will be extending to a third party. So then I have the option of looking internally at loans that have been entered with third-party banks, either by the borrower, which is loan B, or either by the lender, which is loan C. So if the borrower has third-party bank loans, then loan B will be the appropriate interest rate to look at as the cost of borrowing when borrowing from the related party, assuming that the loans are entering into at the same time for the same currency. Because if my third-party bank loan is from 2018 and I'm entering to a related party loan now, then I may not be able to use that because interest rate is something that fluctuates from one year to another significantly. So for this third-party bank loan to be useful, it needs to be entered around the same time that my related party loan. Or I could have loan C, which is basically a situation where the lender buys from the third party, gets a loan from a third party bank, and then that loan I may on-lend to the borrower. So that will be the interest rate that I should be looking at as the starting point to set up the interest rate between the related parties here, X and Y, with the same, taking into consideration the same conditions, that is at the same time, that is basically the same currency. A lot of the times in reality, what really happens is that I lend to on-lend, like the following example. Well, I have 100 million loan being entered with a third-party bank by head office in Germany. Then I do LIBOR plus 1.5. Then I on-lend to subsidiary at 100 interest rate LIBOR 1.5. So in other words, I'm using the original cost of borrowing to on-lend to my subsidiaries. A lot of the times the challenge comes from basically when the origination of the funds is not with bank loans, but is more equity. Then how do I derive an interest rate that represents the likelihood of default of the borrower? And that's where, in a lot of situations, in shareholder loans or equity loans, meaning to say loans that come from equity, one will end up in and especially if the funding is big, above 15 million and cross-border, then you will have to go down the path of looking to external benchmarking. One question that people ask us is, between concessions and internal cups, which one is the right approach? And IRAS has some guidance on this, which is very clear that you first, to apply the indicative margin, you first need to disregard the possibility of having internal cost of borrowing, because the internal cost of borrowing prevails over the indicative interest rate. That's something to keep in mind. So in other words, if I have a bank loan that is comparable and has been entered in 2025, and that bank loan, let's say with DBS, says that my interest rate is SOFR plus, meaning to say base rate plus 2.5%. But then I extend a loan that is less than 15 million and is comparable to my bank loan, and I decide to charge 1.7%, which is the indicative interest rate, I might be challenged by IRAS because the internal cost of borrowing prevails always, as long as it is comparable and it has been entered at the same time. So that's something to keep in mind also, that first internal cup, then concession rates if I don't have internal cups. Now let's talk about what one needs to do when it comes to going into doing an external analysis. So one, we have to look into 4 key things. 1, credit rating of the borrower to make sure that I can define what's the likelihood of default. 2, benchmarking analysis to determine the interest rate. Then demonstrate that the intercompany loan is supported by commercial and financial reasons, like anything TP. In other words, it's not artificial, it's not a scheme. 2, trying and getting only a tax advantage. And the analysis should be looked at the time of inception, as long as the terms of the loan don't change, as long as the loan is short term. Now we have a very clear update on this point number 4 from IRAS, which is that if the loan is long term, and unfortunately we don't have a definition of long term, which we have feedback IRAS that we need a definition of what long term is. Is long term above 3 years? Is long term above 5 years? But the point is that what they expect is that if your loan is long term, that you should be reviewing your interest rate on a periodical basis rather than leave it for the tenor of the loan. So I think that's just to counteract some extreme cases where you have a 10-year loan and then you fix your interest rate at a time where the interest rate was very low, and then you purposely don't decide to revise it. So I think that's what IRAS is caring about. So let's look at credit rating. Credit rating is just basically scoring the likelihood of default of the borrower based on certain financial factors of the borrower. So that's why when you have an external, when you have to run an external benchmarking, the determination of the credit rating can be quite challenging, but it's critical to be able to use it as the basis for looking at interest rates. So in other words, when you are doing external analysis of interest rates, you can just take a population of loans, whether the borrower is non-investment or investment grade and so on. You actually should look at the segment that has the same score of likelihood of default of the borrower. So if my borrower is in the investment band, I should look at those type of borrowers. Or if my my borrower is in the non-investment, that's the type of borrower that I should look. Then after that, I need to look at within the group of borrowers that I have determined for the interest rate, and that is done by looking at loan contracts entered by external parties in the same industry of the borrower with the similar credit rating. Now, the key here is that for TP purposes, the interest rate is made up of a base rate and an interest rate margin. The base rate reflects the interest rate which the borrower at the lowest level of default risk will have to pay. So now the CIBORs and LIBORs have been phased off. So now we have is IBORs. But the point here, this is another reason why you cannot use deposit rates, because a deposit rate is kind of a base rate. It's a non-risk rate. So the expectation from TP purposes is that you have your risk-free rate plus your interest margin. So that's basically how one will approach from TP point of view. The interest rate margin is one that is reflective of the risk of the particular loan. The margin is a compensation for the probability of default of the borrower. The margin is dictated by the credit quality of the borrower, and a lot of the times database will have to be used to run these searches. But if you now, with technology, if you happen to find publicly available contracts of loans that give you interest rates for a particular year, then by all means, because now we have a lot of more resources to find data in general. Question here, which we get asked a lot. Okay, then let's just be practical. Let's just ask my bank to tell me what is the interest rate for SGD loans today, and maybe I just use that as a market rate. So question is that acceptable? What do you think, Minjin?
Well, this is a very interesting thing because if I look back, Malaysia Transfer Pricing Guidelines 2017, the previous editions, they did actually mention that, well, a bank could be used as a guidance when you are determining your intra-group loan. However, with the latest OECD guidelines that issued in 2022, bank opinion or bank code is no longer an options for a company to use that as a reference when you are setting an interest rate for intra-group loans. I mean, in the situations that Adriana, you did mention, like, hey, you just call your friend that working in a bank that just to provide you an opinion on it. While I believe that in a normal circumstances, whenever there's a request for a bank to offer a interest rate for a loan, they will have to go through a lot of due and diligence processes to ensure that they have quoted you the right interest rate they would charge in a third party situations, and hence the answer is no for this.
Yeah, so I think the other point is like the other point, technically speaking, why companies are a bit apprehensive, tax authorities are apprehensive to accept bank quotes, is because their argument is that the argument is that basically a bank quote is not, the bank hasn't taken the risk because they haven't deployed the money. So it's not a serious transaction, because if until, like, anything in business, if I don't give the money, then maybe it's not serious. So there is not an actual transaction. So I think that's the point. Just coming back to external benchmarking, it is good to understand. So what are the key drivers of the analysis for interest rates? So do you mind, Benji, just sharing with us what will be those aspects that I need to consider?
Yeah, sure. So these are the considerations that we do whenever that we have any analysis that we require that what would be a bank would do as well. So first thing, what is the nature and the purpose of the loan? Of course, this will impact that the possibility of the repayment capability of repayment of the borrower. If let's say that you are just for your working capital purposes, or it's just an expansion of your factories, then at least you still have some assets that the bank could pledge it for repayment purposes. Second, market conditions at the time the loan is granted. I think this is very clear that everyone knows that, well, comparing that now, 2025 versus the loan that to be granted in year 2020 or 2021 during the COVID time, which the market conditions are totally different. And hence, one couldn't be like, comparing a loan that to be entered into in 2025 versus a loan that has entered during 2020 and or 2021. The principal amount, duration, and the terms of the loan. Of course, we know that the larger the amount of the principal amount, or the longer the loan is, of course, the interest rate will be much higher compared to a short-term loan or a small amount of loan. Currency in which the loan is denominated, definitely, well, USD loan would have a lower interest rate compared to other currency loans, which due to the volatility of the foreign exchange. While exchange rates borne by the lender or borrower who actually bonds a raise, any security offered by the borrower, any guarantees involved being guarantees offered by anyone in the group, ranking of the loan, senior or subordinated, and of course, last but not least, the credit standing of the borrower. So all these are taken into considerations by the bank when they're granting a loan, as well as what analysis that we do when we are comparing, is that the interest rate to be at arm's length or not at arm's length. Next one, please. Of course, some of the commercial and financial reasons that are to be taken into consideration as well, albeit the impact is not that huge. But of course, like for example, would independent parties have entered into the loan at all? Why do you want to have the loan? Is there any negotiations took place with it when it comes to the intercompany loan, which means that it's the lender at their own best effort to increase the interest rate, or the borrower at their best effort to reduce their interest rate. So this is something that to be taken into considerations as well. All the emails and meeting notes will be the supporting documents. So is there any other options that realistically available? For example, instead of doing a 10 years loans, then it will be a 2 or 3 years loan to be renewed on a periodically basis to ensure that all the interest rate to be assessed and reviewed again, rather than like what Adriana did mention, that you purposely entered to a 10 years loan at a very low interest rate, which is something that is not something realistically that a third-party bank would do it. So even if you have entered into a very low interest rate, the lender should have at some point of time that to review and renegotiate the interest rate accordingly to reflect the current market conditions. Next one. Yeah, so how to determine an arm's length interest rate? Of course, like for example, like you've entered into a loan agreement with intra-group loan with your related party for USD 50 million, inception 1st January 2023 for tenure of 3 years, and it's for working capital purposes. So for us to determine whether that arm's length interest rate for that, of course, first thing as mentioned by Adriana, the 3 things, is there any concessions? If let's say this one, apparently this is not a domestic loan, so concession does not apply if let's say it's a Singapore that lending to a Malaysia. Second thing, the loan of 50 million that incepted in 1st January 2024. So what could we do next is company A has similar loan with a third party, or company B has a similar loan amount with the same number of years and incepted maybe the second half of 2023 or the first half of 2024. So this is a second part, that internal cap that we were mentioning. Or the third option is that to complete a comparability analysis by looking at company B credit ratings and do a search at the market at the available database to say that for those USD loaned with this amount that injected in 24 or late 23 with a tenure of 3 years, what would be the interest rate looks like. So these are the these are how we could determine an arm's length interest rate based on the intra-group loan that a company has entered into. Well, the last button is the cost of fund, whether that considerations that be given that the lender cost of funds, when if let's say that the loan was obtained by the lender from a third party for on lend to the borrower. So what would be the cost of funds of that? Like one of the example given that if let's say that the third party bank charge a SOFR plus 1.5%, the same could be used as a interest rate for the loan that extended to the borrowers. So an independent lender will not lend below its own funding cost. So if let's say that you see that, oh, the lender is paying a 1.5% margin, in a third party situation, it will not lend at 1%, right? So if a parent company has to borrow externally at 6%, it wouldn't make sense for them to lend internally at 2%. So because this will provide a lower bound for the interest rate, likewise, the borrower credit profile sets the upper bound of the interest rate as well. Yep, Adriana.
Yes, so let us look at some of the Singapore changes, even though I have spoken about it through the session today. What's the change, what's the expectation? I think what the Singapore change really is tidying up the options for having interest-free positions. I think IRAS has been quite vocal on this, that they don't like interest-free positions, and what they have done is flip the onus of the evidence on the taxpayer to basically say, our position is this. If you want to demonstrate otherwise, then you have to show us as to why do you want to treat it in a different way. So for domestic loans entered before 1st of January, we have the interest restriction approach, which is basically if the lender is not in the business of borrowing and lending, then the domestic interest restriction will apply, and there is exemption for transfer pricing documentation. If the lender is in the business of borrowing and lending, the arm's length interest rate will apply when the principal value of the loans does not exceed 15 million SGD. So in other words, you can apply the indicative margin, and you may be exempted from DP documentation if the indicative margin is applied, otherwise transfer pricing documentation is required. So this works for loans up to 1st of Jan. Now, there is an important thing here, which is how do you determine loans entering before? So when it is an agreement, it's very clear cut because you go by the date of the agreement. But if the agreement is not there, what we understand from discussions in frequent asked questions on the changes from IRAS is that they will consider the date of the loan, the beginning of the financial year. So in other words, if I have some non-trade payables that I have at the end of the year, and I haven't cleared it from 1st of Jan 25th, and they continue to be there all to 25th, that is considered a loan being entered after 1st of Jan 2025. So that's something to keep in mind, because I have come across more situations where there is no loans agreement, and it's very hard to understand, has it been entered before or not? So that's something to keep in mind. Then what happened with loan entered, domestic loans entered after the or after 1st of Jan. So what is going to happen is that the indicative interest rate can apply as long as there is no, the lender or the borrower are not in the business of borrowing and in the borrowing and lending. Then I can use the indicative margin regardless of the value. And if I use the indicative margin, then I'm exempted from documentation. If I decide not to use the indicative margin, then I will have to prepare documentation to substantiate the interest rate. If either the lender or the borrower or both are in the business of borrowing and lender, the arm's length interest rate that can apply to the loan not exceeding 50 million is the indicative margin. So in this scenario, the indicative margin can be used, but again, is capped or limited to the loans for 15 million. In this scenario, so is loans where I use the indicative margin are exempted from documentation. If I decide or I cannot use the indicative margin, then the transfer pricing documentation will be required. So the largest pool that have been impacted is under situation number 1, which is when I'm not in the business of borrowing or lending, and then I cannot use the interest restriction anymore, and now I have to use the indicative interest rate. And if I don't use the indicative interest rate, then I have to prepare documentation. So this is the larger pool of clients that we have observed that have been impacted. In the cross-border loans scenario, actually nothing has changed. I still have that arm's length interest rate where the principal value of the loan does not exceed 15 million. I can use the indicative margin. So I can be exempted from documentation requirements if I use the indicative margin. Exempted from documentation requirements if my total loans received or provided are below 15 million. Otherwise, TP documentation is required to substantiate the arm's length interest rate. So if we see the scenario here, basically in scenario 1, I have cross-border loans, so nothing has changed. If above 15 million on an aggregated basis, I need to prepare documentation. If each loan is not above 15 million, or for those loans who are not above 15 million, I can use the indicative margin rate. In the domestic scenario, then what I have is if these loans have been entering from 1st of January 2025, then I don't have an indicative, the interest restriction anymore. I have to consider using the indicative interest rate as a default policy. And if I deviate from that default policy, then I have to prepare documentation. So when are taxpayers expected to prepare documentation when the loan is entered? How often does taxpayers have to prepare documentation? Now we have to look at it annually in Singapore, particularly in loans. When is long term, I have to double check my interest rate. And we spoke about it earlier, important to have the contract now to know whether the loan was entering before 1st of January 2025, which now is a little bit too late. But to prove also the features of a loan, if it's important for me to prove that the loan is a loan in substance. So a couple of final points. Understand the tax risk. Is it an income or an expense in Singapore? Also understand if the IRAS is likely to challenge also from withholding tax point of view, even if it is just an expense, because yes, I might not be having an interest to have an expense because I won't have a tax deduction, but I could always have a reason for wanting for the loan to be a loan for withholding tax purposes. Always check, as I said earlier, the internal COPs, because as we mentioned in Singapore, internal COPs prevails over indicative interest rate. So within the two, the internal COP will prevail, or the cost of borrowing. Always, if you are managing in other countries different to Singapore, check limitations on interest deductions, think capitalization rules, as Singapore is quite flexible on this aspect, but other countries are not. So that can impact your decision on whether you want to push down funding in the form of loans. So with that, let us look at a few questions that I can see we already have. So let me start with one. If a Singapore company is giving a loan to an Indonesian affiliate company is in USD, is it acceptable to use secure overnight financing rate as interest rate? So remember, for the person who is asking this, remember when we asked earlier that is deposit rates acceptable, or is risk-free rates only acceptable? So in your case, if you only use SOFR, you're using only the risk-free rate. So you need to add a margin on it. Okay, so SOFR is not sufficient because it's just a risk-free rate. You need to add a margin on it. Will intercompany advances that are payable on demand with no fixed repayment date be considered as a loan in the absence of a contract fixed repayment date and obligation to pay interest? Can this be regarded as a equity and hence no arm's length interest rate required on the advances? What do you think? That is, intercompany advances that are payable on demand with no repayment date can be considered a loan, or are they considered equity? My view is that advances that are repayable on demand and particularly are left collected for beyond trading terms, I will say that it can be deemed a loan, because if the advances are basically prepayments for a service or a supply, then I don't think I can characterize that as an equity. I think if anything, it will most likely be characterized as a loan if it's left unsettled beyond trading terms. That's what I believe. But I don't know. I don't see how you can characterize it as equity. What do you think, Benjin?
Yeah, I have to agree with you with that. I mean,
Yep.
yeah.
Someone is asking, does Singapore has a minimum TPD? No, Singapore doesn't have a minimum TPD. In Singapore, it's either full TPD or TP policy to prove that it's an arm's length if it is material, kind of a thing. So there is another one that we have here. The cash pooling one. If Singapore company has a cash pooling arrangement with a related party in Singapore, the loan interest rate is based on bank rate plus certain margin, 0.5%. Do we still require to do TP report? The answer to this is yes, because if this cash pooling has been entering after 1st of Jan 2025, so keep two distinctions. If the cash pooling was before 1st of Jan 2025, then you may take hold of the interest restriction rule, but you need to see if this is applicable for the cash pooling arrangement, because I don't think the interest restriction rule was deemed to price cash poolings in the first place. If it is after 1st of Jan 2025, then because your rate is 0.5, which is below the indicative margin rate, which is 1.7, then yes, you have to prove by documenting how would you, or what is the basis for that 0.5. Do you have anything on this one, Benjin?
I think because the band rate that they are looking at is that the deposit rate that he's referring to, because it's a deposit rate, definitely, it's not something that agreeable by the IRAS, I would say so.
Yeah. Someone is saying, does the company need to charge interest on loan to shareholder? Does an individual local shareholder owning 50% shareholding need to charge interest on loan to the Singapore company? So the first one is yes, if you have a loan with your shareholder, you are meant to do, if it is a loan, you need to apply interest rate. Now, The question is, now there is a variation because what if the shareholder only owns 50%? So will the shareholder be considered a related party if I only owns 50%? And I think that's where you need to understand what's the level of control of the shareholder, even if they own 50%. If you can prove that the 50% of the shareholder is not sufficient to exercise control over the decision of the company, let's say because he's not part of the board of directors, or because the board of directors is him and someone else, then you might be able to prove that it is outside of the scope of TP, and then it's an open market transaction. But if you own 50%, but at the same time you are the director and the only one who make decisions, then you exercise control on the company. So remember that transfer pricing in Singapore is driven by the concept of control. So 50% is an indicator that you might not exercise control, but you also have to rule out the possibility of control by management. Maybe we have time for one more question. Let me see. Please clarify the below summary is correct. If the loan is between two Singapore entities up to any amount, base rate plus indicative margin can be used. If the loan is cross-border loan up to 15 million, base rate plus indicative can be used. If the loan is cross-border loan more than 15 SGD, benchmark is needed. Yes, correct. That's a good summary. So let me see. It's quite a few things. So a few people are asking that whether we share the slides. We don't share the slides, but we will share the recording of today. Can a parent company offshore entity lend at interest-free to SGD at interest-free? Can SGD parent lend interest-free to MI subsidiary for working capital purposes? I'm going to answer this one like very simple. No. I mean, IRS has been very clear that they don't believe or they don't accept interest-free positions. And bear in mind that when Singapore is the lender, there could be even more of an issue associated with the interest-free. So strictly speaking, no. So I think with that, we can just call it a day today. We have quite a few webinars coming and a few accolades happening. We always say to everyone, we don't charge for these webinars so far, but we like everyone to follow us on our social media in YouTube and LinkedIn, Instagram. So we're everywhere. You can see the recording when it will be sent after, I think today's Thursday, will be sent on Monday. If you want to get in touch with us, here is our details. Feel free to reach out. And thank you very much for attending today to our webinar. We see you soon. Thank you.